Perfect. Oh, I'm unmeeting Brendan. That's great. Thanks, Brendan, for being with us. Okay, guys, so let's get started. Again, thank you for your patience. Welcome to our joint presentation between SBIDC and Evergreen, on which we will be discussing and introducing to you guys the Eqid initiative, which is Equitable Industrial Development Initiative, which is sponsored by City Foundation and also supported by the Mayor's Office for Minority and Women-Owned Business. So we're delighted today to have with us, I'm representing SBIDC, Southwest Brooklyn Industrial Development Corporation. We're a 40-plus-year-old nonprofit based in Sunset Park. We provide technical services to industrial and manufacturing businesses, also advocacy services, networking services, among others. My name is Michaela Skognic. I'm Business Services Manager with SBIDC. And also today with me is Leah Archibald, Executive Director of Evergreen Exchange. Leah, would you like to introduce yourself briefly?
Sure. So I'm the Executive Director of Evergreen. We're the local development corporation that works with businesses in industrial North Brooklyn to help them grow so that we can keep high quality jobs in our community. I'm super delighted to be doing this presentation with our friends at Southwest Brooklyn.
Oh, sorry, Leah.
Oops, I got muted.
Gently, yeah.
We think there's a lot in here that both of our business communities could benefit from. And so I'm really, really delighted to see you guys here today at our presentation.
Totally. Thanks, Leah. And also, finally, I wanted to introduce, we have three of our colleagues from the working world. We have Alice and Michelle, Alice DiMaggio and Michelle Sanz, both senior project officer with the working world, who is community lender that builds cooperative businesses and who have been supporting us all along in the process. And we also have Brendan Martin, who leads the organization, The Working World. Guys, would you like to briefly introduce yourselves?
We can start. I'm Michelle at The Working World. I'm a project officer, as Michaela mentioned, and I actually used to work at SBIDC. Yeah, I'll pass it on to Alice.
I'm Alice Maggio. I'm a project officer with Michelle at The Working World, and we offer finance and technical assistance to worker-owned businesses. Brendan?
Hi. Hi, and I'm Brendan Martin. How y'all doing? I'm Executive Director of The Working World. I've been working with legacy businesses to preserve them and help pass them on to their workers since 2004. And as Alice and Michelle said, we provide financing and technical assistance to people around the city and business owners and workers who want to follow in that same footsteps. Thank you for everyone for being here.
Thank you, guys. Okay, so, we also have folks from the city. Sarah, I believe you guys are here too. Thank you for being with us. I wanted to just dive right in honor of time. Leah, would you like to start us off with what's the need or what is the value that these kind of programs can have right now for business owners?
Sure. So, why this and why now, right? So just, to provide an overall framing for, why we're participating in this initiative, a lot of businesses are led by boomers, especially, that are preparing to retire. And not every one of these family-owned businesses has an obvious next successor. Additionally, you know, just in terms of the context of the businesses our organizations serve, they are, you know, to the very last man or woman, family-owned businesses. So whether, you know, you are a business owner and, you know, you're a boomer and you're thinking about retiring, a lot of the businesses we work with are slightly younger than that. And retirement isn't necessarily on the horizon tomorrow or next year. But I think it's really important for folks to, when they plan for their future, to know about all the options out there. And, you know, you know, there are a variety of reasons that, you know, potentially selling your business to your employees can be a beneficial option for your business. You know, if you have no obvious successor, if your kids or relatives don't want to get into the family business, I mean, you might be able to sell your business to a competitor. And that's a possibility, and a lot of folks, and even folks, you know, that we work with do that. But it was really fascinating for me to learn that like 70 to 80% of the businesses that go on the market don't sell, right? And so this is, you know, not just through a broker who would, by the way, charge 15% of whatever the value of the sale is, but like even, you know, to competitors, they may not be interested in purchasing. But, you know, one of the cool things about selling your workforce is like, these are folks that know the business well. You know, it's, and to understand that there are actually financing options that will, you know, allow this opportunity to become reality is really fascinating. It's a great way to, you know, keep your folks employed, keep your legacy intact, you know, all the years that you spent working on building your business. This is a great way for you to extend your legacy. And when you transition the business to employees, you can be involved in the future of it as much or as little as you want. There's, you know, a huge range of involvement that you can do. You know, you can sell it, you could stay on as an employee. It's, you know, our presentation's going to explain quite a lot more, and then our friends at Working World will be able to answer direct questions. But, you know, ultimately, it's a great way to find a willing, skilled buyer for your business, to preserve your legacy, and, you know, for you to exit on your own terms. Mm-hmm. So I will leave it at that and pass it back.
Perfect. Thank you, Leah. Thank you so much. Right. So this is exactly the need that that prompts this initiative. You know, seeing that this fact that 70 to 80% of the business that are put onto the market do not sell, and this is I want to go ahead with the presentation just to explain to the folks we have here that I know we have a lot of partners. Thank you for being with us. And we also have a lot of businesses. So to tell you a little bit more about what exactly is this initiative, this collaborative initiative that involves, you know, a community-based lender, that involves the city as developing in some way this collaboration in which the technical organizations such as Evergreen, such as SBABC, such as BUC, and many other organizations are taking part in finding, in educating business owners and employees as well about this alternative, and also guiding them along the way if this ends up being a good alternative for them, and that matches the kind of business that we're looking for. It meets like the eligibility criteria, and we will get into that. So I'm meeting just one more person. So getting into, you know, the content of the presentation. First, what are conversions? What's the conversion of owner, business owner owned business to an employee owned business? Basically, worker cooperative conversion is the transition of a company from sole or family ownership, you know, a very hierarchical structure in which you have the owner at the top and then workers at the base, to employee ownership, which obviously democratizes both ownership as well as decision making. So employees have governance of money and decision making power as well. What is employee ownership? So I will follow up this presentation, sending this email around, but we just wanted to explain to you so that you can actually look at these slides yourself, but understand that employee ownership changes the way we traditionally understand businesses in terms of who owns it, who controls it, and who benefits from its success. So in the spectrum, we have on one side the conventional business that we're used to, and probably most of the businesses that are here are those conventional businesses in which you have, you know, investors and shareholders who share ownership and decision making. And then on the other side of the spectrum, you have worker-owned cooperative, which is the kind of entity in which we're trying to, or kind of structure in which we're trying to promote. In which the owning, the controlling, and who benefits from its success is shared among the workers being worker owners. And here we also add some information on ESOP, Employee Stock Ownership Plan, which is a question that we get very often about what's the difference, so you guys can look at this yourselves. And here's a comparison between ESOP and worker cooperative, which are not the same. What legal forms do cooperatives use? So you guys can see here, basically most kind of businesses can become a worker cooperative. So can be a worker cooperative having cooperative status, or being an LLC, or being a corporation, or if you're a nonprofit, or even if you're an ESOP. So you see many different forms of, many legal forms are compatible with cooperatives. And then just jumping right into the benefits and building off what Leah was saying before. Why should a business owner consider selling their business to their employees? So the answer here is twofold. There's advantages to the business owner and there's advantages to the employees. So for the business owner, you capitalize the value you have invested in and created for the business. You avoid the 15% business broker fee. You can access tax benefits available for worker-owned businesses. You preserve the legacy of your business and the jobs you created. And then for the employees, you build wealth through equity in the company and the potential for increased income. You increase job security and resiliency during economic downturns. And I think this is a very important point, especially considering the scenario in which we're actually going through, you know, COVID being obviously a public health crisis and being an economic crisis. We are finding that this alternative has even more value at this time in which we're going through a lot of uncertainty. And it's an interesting thing that historically, the community lender that's here with us today, the Working World, actually started from, was conceived during a crisis. Brendan, if you're with us, if you'd like to tell a little bit about, the case with Argentina, or anyone from the Working World.
Yeah, I can tell you a little bit about it. Argentina is where I began. I lived there for 7 years. I began doing this kind of work. I had worked in business. I was a business owner before then, and helped work with the more veteran business developers to create a business in the 90s and early 2000s. And then I wanted to take that experience and extend it to others. And I went to Argentina after they had a financial crisis. That was every bit as potent as what we're going through now, arguably more so. They had their financial crisis closed down the entire economy. And the odd thing about that was, obviously when you have a crisis and you have businesses shutting down en masse, it's devastating. But people who responded to that crisis, rather than just letting it happen, got a chance to reopen a lot of these businesses with the workers who had been in the businesses, working with sometimes the owners. Sometimes the owner had just left the country and they had to do it on their own to reopen the businesses themselves. And that was where I first got my start working with legacy businesses and seeing the possibility of people who had done nothing else than be workers, how they could actually, as a group with some training and support, learn how to run the company. And there's lots of different levels of that. Certainly some people are better positioned than others, but there's a lot more potential there than most people realize. And that's what I saw in Argentina, and that's what I wanted to bring back to New York City and see as really a powerful opportunity for the crisis that we're faced with right now.
Mm-hmm. Thank you, Brendan. Thank you for sharing that with us. So as you guys can see, there's a little bit of some synchronicity right now with the current moment, going through an economic downturn. And also going back to the advantages to the employees, you know, converting your business into a worker cooperative can improve business productivity through solving and increase buy-in. You know, you're empowering workers who know how the business works and who have been there for a long time, and increase control and voice in the operations of the business. So these are some of the advantages to both business owners and employees of doing conversion. So having stated those different elements, defining, you know, conversions, worker cooperatives, and the advantages, I want to tell you a little bit more about the program. What exactly is this initiative that we're presenting to you today, and how we can support you if this is something you find interesting. So how it works. Basically, here we see three big phases. There's an initial assessment that lasts 1 to 2 weeks. So an initial assessment of the business considers the financial and socioeconomic impacts of the business. So here is where our organizations, the technical providers organizations, along with the working world who have experience in doing this, we're looking at your business and we're trying to determine whether you would be a good candidate for this program. So companies that make the best candidates are profitable. But here's you know, there's something to be said that at the moment we're really like looking for pre-COVID because we understand that things have changed. And their conversion to employee ownership can have a meaningful impact on the lives of the employees or community, meaning that we're looking specifically also for businesses that have at least 3 employees. We'll get into that. And we're also trying to hopefully have employees who, you know, who come from disadvantaged backgrounds. So that are all elements that come into play when we're doing this initial assessment. So there's some parameters, but it's everything, you know, we're looking into everything at the moment to see the range of businesses that could work. Then there's a 2-month period where financial, operational, and legal due diligence is carried, conducted, of course, with the owner's assistance, you know, interviews, phone calls, also taking a look at, you know, financial documents, of course. So to assure the soundness of the company and inform a transition plan. The plan is used to effectively transfer managerial duties to the new owners. So there's really 2 big components here, and I think Alice and Michelle will be able to talk more to this if there's any questions about, you know, we're looking at your business and looking at what do you do as a business owner, who could replace you, but also looking at the financial components. And that lasts roughly 2 months. And then there's a period of sale and follow through. It's a 1 month, there's a 1 month timeline for that. If the due diligence process and transition plan are completed without issue, the company sale is finalized and the first payment is made to the seller. So here it begins a period of, you know, training the employees into assuming different kind of duties and decision making. And ownership is transferred. And we will look later at some case studies so that you guys can see how this might be a feasible, viable option for you, since actually the working world has a lot of experience previously in converting New York-based businesses. Who can support me in converting to employee ownership? There's financial guides the working world can provide. Then there's technical assistant partners. And here it's a cohort of technical organizations that will be going through the due diligence with the businesses themselves. And we also have a network, many of them who are here today. Hi, everyone. And together we are trying to identify potential businesses for this project. And also all these technical assistance partners can help you with other stuff of your financials and operations, including business, financial assistance, recruitment and training support, which is really like the day-to-day of this organization. And then there's also city support through the Equitable Industrial Development Initiative, which is this program. So the city will provide business owners with a free consultation, technical assistance, and a pathway to a private lender for eligible businesses. So eligibility criteria, how to know if I could be a good match for this program. If you own a small business, if your business was profitable before COVID-19 pandemic, and I guess we can talk a little bit later about what is profitability in this context. If your business employs at least 3 workers, and if the business is located in one of the 5 boroughs of New York City. So if anyone has questions about this, please write them down and hold them for the Q&A, which we will get into very shortly. Okay, how does the owner get paid back? Okay, so deal structure, right? If eligibility criteria are met, working world, our lending partner can finance the purchase of the company on behalf of the workers. So the owner would receive a 50% down payment once the deal is closed, and then you need to be repaid out of annual profits over time until you receive 100% of the price the transition of ownership to workers is gradual. Many times involves or is encouraged that it will involve the owners being available to provide guidance. And that's something that we can also talk a little bit more if needed. Okay, so very short animation. I will go over this quickly, but about the deal structure. So we have the sole owner at the top of the pyramid, and then the employees. There's an agreement to worker-owned business. So here's where the working world comes in as a lending partner. And if the working world finds that the business reaches certain criteria of eligibility that we were discussing before, there's potential for a deal, right? So, or there's a deal that's been struck. So we have the former owner, right, that will receive a 50% down payment from the working world right away once the deal is closed. And then there's a transfer of ownership from former owner to employees. And then for how annual profits are distributed, what's the allocation of profit during the owner repayment, basically. So 50% of these annual profits go to the former owner over time. 30% goes to the working world as their fee, and then 20% goes to the worker owners. And this is the process until the former owner is completely paid. Oh, sorry for that. And here it's important to mention this, I think. The owner is obligated to participate in the transition, offering on-call assistance as needed. So that's for the deal structure. And now we wanted to discuss briefly two examples that we have. So Michelle or Alice, whoever you would like to take the lead on talking about how this program has worked and some lessons learned from this transition conversion processes.
So I can talk a little bit about JKS, which is it's a printing company in the Rockaways. It's kind of a classic example of a Main Street business, the kind that might be going away if the owners just decide they want to retire and they can't find anybody to buy their business. And in this case, it's a company that's been there for a long time, about 30 years, and they serve a lot of the schools. They print t-shirts and everything for the local community. And so it's really a part of the downtown area that it's in. And these owners wanted to retire a couple of years ago. And instead of just closing up shop, we were able to finance the owner's retirement basically through a conversion. And the employees became the worker owners of the company. So they're now, in fact, that was in 2017 when that started. And now the workers, the owners have been completely paid out, and now the worker owners are complete owners of the company. I'd say that probably the lesson learned is this is a very, very small business, and we would like to work with slightly larger businesses. They're only about 3 employees there now. So that's kind of like the lower end of the range on the size of businesses we'd like to work with.
Mm-hmm.
I can talk about Brooklyn Stone and Tile. It's the project that I work with the closest here at the Working World. They are a stone fabricator and tile installer at the Brooklyn Navy Yard. They moved from their original location, so if that is something that you are thinking through or have any questions about, feel free to ask. But this is an example of a company that moved from the original location. They are $1 million business and growing very rapidly. And they're operated by 11 to 12, sometimes 12 workers, many of which are workers of color that have been in the industry for decades. They're all, we expect to make most or all of them worker owners in the future. And we also are helping them apply for minority women-owned business certification so that they can procure from the city.
Excellent. Thank you, Michelle and Alice. That was great. Okay. That brings us actually to the end of the content of the presentation. And I'm going to stop my share here. All of these we have a lot of, the city has provided kindly a lot of materials that we can send everyone if you're interested, brochures, flyers, all of the information is there. So I'm gonna stop sharing this, and of course I will share the presentation with everyone as a follow-up. So yeah, just wanted to jump into Q&A, which will be led by Leah, will be moderating, and I wanted to start. If it would be possible to get a little bit of information about who here is business, manufacturing or industrial or another. You can put it in the chat if not, or you can unmute yourself and give us an as you ask.
Right on. We have a bar owner. Let's see, I'm going to start narrating this.
Perfect.
I know we have some manufacturers here because I'm looking at you. Who else wants to talk, give us one sentence about their business?
I can talk.
Right on.
So yeah, so I'm my wife is also my partner is also on this call. Martina Salisbury. So we own 27 Incorporated. We're a design build company in Brooklyn. Pre-COVID, we had about 60 employees. Now we're more like 25. So you know, we actually have been talking about maybe doing an ESOP at some point. So I'm curious to hear what the difference is between this model and an ESOP. I know a little bit about ESOPs, but you know, we're not necessarily looking into retiring, right, you know, in the next couple of years, but it could happen, you know. So we're definitely interested to hear more about it.
Great. Who from Working World could take that question? That's a really good one.
I think actually Brendan would be good for this, but there is materials in the slideshow that will be sent around. So Brendan, I pass it to you.
Okay. You know, it's easy, so we often say don't let it seem mystifying. There's a lot less difference between what we're describing and the pure and an ESOP than there is difference. And from current ownership, yours, a simple form for a smaller company transitioning to a worker cooperative ownership.
Brendan, we're having a rough time hearing you. Your audio keeps cutting out.
I was afraid often. I know I have to dial in.
Yeah, Michelle, who's that? Alice.
I can take a stab at it, and Brendan, if you want to add anything. I think the main idea of the difference between the ESOP and the co-op is that an ESOP is basically you have to go through a lot of legal hoops to create a trust. So you're actually turning your company into a trust. It's owned by a trust. And then that trust has trustees. You could make it democratic by having the trustees be the workers, like the employees, and you as founders could also be trustees. And a worker-owned co-op is just a lot simpler. It's basically just making all of the workers into owners of the company. And as one of the slides showed, there are lots of different legal forms that can take. The ESOP is a very specific legal form, and there's a lot of work to make that happen. But with a worker-owned co-op, you can actually choose from a lot of different structures in terms of just like legal structures. And then the worker-owned co-op part of it can be written into the bylaws of the corporation or can be written into the operating agreement of the LLC. And basically the idea is there's one worker, one vote. So it's and then you can choose what all the workers get to vote on. Usually it's something like the board of directors. Some smaller co-ops decide to vote on a lot more things, like not just having the annual meeting of all the workers and choosing the board there. So there's a lot more flexibility in the worker-owned co-op structure or model than there is in the ESOP, and it's simpler to set up. It can be simpler and less expensive to set up.
Can I just add one thing?
Mm-hmm.
I think if I remember correctly, in order to do an ESOP, you have to have a full C corporation. If you have a sub S or an LLC, I don't think you can do an ESOP.
That's probably true. I'm not quite sure, but it sounds right to me.
So anyway, thank you for the meeting. I think it's got you've got great information. My interest to know is how are you doing your valuations? In other words, you mentioned one company that was small. You didn't mention what the purchase price was. 50% was paid at the conclusion of the transaction. And then the balance, I assume, is paid out of profits. So it's kind of a leverage buy-in by the employees. But how are you establishing the value? Because usually in these kinds of deals, there's a real gap in what the owner expects to get from a business investment.
That's a good one. Who wants to take that on your team? Valuations.
I can,
Fascinating.
yeah.
Michelle,
I can start,
okay,
and then
great.
Brendan, you can fill in if there's anything that you think I missed. So we tend to work with earnings-based valuations. So the earnings of the trailing years times the multiple that the business owner is seeking toward the asking price that they'd like. So if your net earnings over the past 3 years are an average of 300,000, and you're looking for a 3 as a multiple, then that would be a $900,000 valuation or purchase price. So that's how you can think about it. There are other companies and other ways of doing valuations that involve different calculations, but ours is quite straightforward in that way. Brendan, is there anything you want to add in?
No, I mean, it's just that. I think it's just the earnings. I mean, really, the valuation is based on the projected earnings. But the way to get projected earnings is look at the past earnings. If there are sudden things that happened, like COVID, that can change that. Now, on the one hand, if we look at an industry and we think, wow, you had good earnings, but this industry is very questionable now, given COVID, that can mean that just looking at the past earnings isn't going to be enough. We're going to have to incorporate that assumption. There are ways for the owner, though, to avoid, they say, yeah, but I'm pretty sure my business is going to bounce back. Rather than taking a lower valuation, they can choose to take a lower down payment and say, I'll bear some of that risk and get more of my payment out of the future profits. There's different negotiations that can happen like that to try to make it work for everybody. And the reverse can also happen. You might say there's some businesses that had a really bad quarter and have all of a sudden bounced back and look just as good as they did before COVID. And we might be able to say, okay, we're going to not include that quarter in your trailing earnings. We accept that was an anomaly. So it can also work in your favor. Or something changed 2 years ago, so we're going to include, and your business got a lot better. We're not going to include earnings before 2 years ago when giving you your average. So it can work in your favor as well. There definitely can be a disconnect between when an owner, and they think I put 30 years into this, and all the money I put in over the years. Sometimes, your earnings are what your earnings are. And it's like trying to sell your used car. It doesn't matter how much you put in over the years. It just matters how good a car it is now. And that can be very real. It's great to talk to brokers about it beforehand, see what you, but we walk the owner through that. And rarely, usually people understand, hey, the reason you'd pay for something is because it's going to yield future earnings. And we work carefully to try to make sure we can see eye to eye with an owner on that.
Are you finding that the 3-year or 3-time earnings estimate is an average, or that seems could be low, could be high, depends on the business, as you say. But is just as a rule of thumb, you mentioned 3 years rather than mentioning 5 years, for example.
Yeah, I mean, between 3 to 4, you could get higher. It depends on the size of the company. A lot of companies are so small, you can't take an industry multiple. They're a lot more fragile. They depend a lot, as I'm sure some of you owners know, when you're in a small company, if you thought if I walked out tomorrow, that business might collapse, or might just, be in really hard times. If you're a 100-person company, there's probably a lot of people helping to run the ship, and if you were gone, it wouldn't be as fragile. So unfortunately, you get a higher multiple if you're bigger. You can get, as you start to become a larger company, you get more towards an industry standard multiple. But a 3 times 1, if you think 3, you're probably not going to be disappointed. It's possible you can get towards 4. 5, again, it really depends on the size of the company. But we've seen 3 to 5. But it's usually there between 3 and 4 for companies we're talking about that are between 5 and 10 employees.
Moving the question a little bit. How would you bracket the bottom end and the top end of the purchase price that you're ultimately working in? What is the zone that you guys are working in?
We do anything from, actually, Alice mentioned JKS earlier, and that was only a few $100,000. She also mentioned that was a smaller shop than our average. So we put 500,000 as a real minimum. We try to go for companies even at $1 million or more. And we've bought companies, we've looked at and considered and helped buy companies up to over 10 million in valuation. If it gets to the higher numbers, we often involve other financing sources, and the deal can get more of the time is spent on that deal because there's so much structuring to it. It's a lot more money changing hands. On the positive side, usually those bigger companies, again, have a lot more personnel and the diligence is easier to do because there's a lot more codified systems.
And how do you structure your own income?
Our income is based similarly to the owners. It's a percentage of the profit going forward until we get paid back. And then we'll often own a small share. So rather than owning the whole thing like a normal investor would do, we're allowing an opportunity for the workers to become the majority owners. We'll keep a little bit for the future to try to make up for the downsides. You know, when we look at, well, what if this thing goes to zero? We just lost $1 million. It takes a lot of winners to make up for that one loser of we lose $1 million investment. Sometimes we invest in a business and actually have to cover carrying costs because they're losing money. So we will take a little bit in the future after that, but generally we get paid out along with the owner. We try to make it so that future payout that you talked about, that's profit based, we'll get paid out of the same pool of money. So will the new worker owners. They'll get their extra profit out of that future source of money. That way we're all looking at the same pool of money. We're all motivated to increase the size of that same pool of money. I think that's the chart that's up there now. I love that chart.
Are you taking an upfront fee?
We do not do fees.
No upfront fee.
No, I should say that the city of New York is in part of their support for this kind of work. We already have some contracts with the city of New York, discretionary funding from the city council to pursue this type of work. So we have some support already. That means we don't have to charge any upfront fees.
That's great.
Which is very uncommon. You're asking the question, you know, usually it's pretty expensive for an owner to look for this kind of support. And this is one of the tremendous things that the city is helping to offer, is to do this kind of deal without having to pay $30,000 up front or something, which is what often owners are faced with this kind of deal.
I think this is great, and I think I can probably help you in a lot of ways. I sent Marcella an email with my contact information.
Right on. That's great. Do we have some questions from some of our other businesses? You can either unmute yourself and ask them with your voice, type them into the chat, and I will narrate them. Whatever is your preference. I think if I don't get anything in the next moment or two, I know I've gotten a few questions from the businesses that I've been doing outreach with that I would proffer. What I got a lot of when we did the outreach with businesses we thought would be interested in this, the response, I got numerous responses. I'm so young, you know, I'm 41, I'm 55, I'm not thinking about selling anytime soon. So, you know, in that instance, what does somebody who is looking at the future and wants to lay the groundwork for a potential transition someday, what do they need to do now to you know, utilize this as an option if it makes sense down the line?
Yeah, I can kick it off and see if Alice and Brendan have anything to add. I'd say training up workers is definitely a very good idea. You know, being very operationally, what is the word, thoughtful. So if you do want to sell and thus not be involved in the company when you do, you could think about what your responsibilities are and start training up your workers to take some of those on. You could even think of a possible replacement for you, because there's a lot of situations where the owner in a conversion transition does need to be replaced. So we don't assume that the workers will be able to take on all responsibilities, though it's usually more than the owner thinks that the workers can do. But you know, there are some circumstances where the owner does need to be replaced. So thinking through who could be a replacement. And also, because you obviously want a high valuation, I'd say keeping your books really good, clean, and up to date, and also strategically thinking through when your earnings are highest, and when any buyer looking at your business would see that this is a business that will only continue to grow and continue to earn money for the future buyer. So I'd say those things, which is, you know, being thoughtful about your operations and how you're training up your workers, and beefing up your earnings before you do before the couple years before you sell. Anything to add, Alice and Brendan?
That's great. That's super helpful. Folks, who else has some questions? Don't be shy.
I guess it's a clarifying question from Ryan Bluestone. Can you explain the point described a little further? So usually this type of transitions cost about $30,000 up front. However, thanks to the agreement with New York City, this is bypassed. How does that work? And did I hear that correctly? So there's no fees, right?
Yeah. Oh, Brendan, you can take it.
No, it's okay. Go for it.
Yeah, so that's just consistent with the way the working world has done these transactions, where we don't charge a fee, which is different than, you know, if you go with a broker. What we do, the money in the chart that you saw where the working world is getting money back, that's money toward the loan that we lent the workers to buy the business in the first place. The partnership with the city is really us working with the city to work with FBIDC and Evergreen and organizations like that to connect us to businesses that are looking to sell. So that's the way in which we've kind of avoided that fee. Brendan, anything to add?
Yeah, I mean, and so there's a couple of fees that you also need to hit with. One is the broker, which you might still, if you find us through a broker, you will still have that. Of course, if you go through this process that SBIDC and Evergreen and the city have set up, you can avoid that. So that's one fee you miss. There's also usually a fee, and that's the $30,000 I was referring to, for doing setting up the deal, doing the legal work, closing it. A lot of technical assistance providers just make their money on closing the deal. There's two downsides to that. One, you got to pay them a fee up front, and a lot of business owners look at paying somewhere between $10,000 to $30,000. So $30,000 is not an exact fee. That's just one that can happen. They're looking at paying $10,000 to $30,000. Have someone help them set up an ESOP or find the capital, et cetera. The other downside of that is those technical assistance providers are often motivated just to close the deal and then move on. And if you're planning on getting profit out of the future success of that company, you're going to be on your own. The working world. So in addition to having support from the city, so that we can float, you know, this kind of work and just get paid later on the later upside. It also means we're motivated to make sure that later upside happens. You know, we tell you, look, we believe enough in this deal that we can get paid later by a success, the same way we're expecting the workers and that owner to get their money on the backside. So by being not just a technical assistance provider, but also a capital provider, we're putting our money where our mouth is, and we're saying we'll get paid later along with everybody else. So some of that is the way we work as the working world. Some of that is because of what the city has set up to make this conduit right here where you can meet without a broker, and where we can get this work done. So it's a tremendous amount of work that all the different partners on the phone have done to put this together, and it's an incredible, relative to what's available normally in the market, it's an incredible offer to business owners.
Great. We've got a really good question, nuts and bolts question from Dawn Ladd. When do you pose the question to employees to see if they're interested? How does one broach this with their team? Who has advice for that?
I can lay the basic things, and then Brendan, with more experience, can fill in. So any owner who's selling a business, you know, we've encountered the situation where the owner doesn't want the workers to know. I mean, it's if you're on the worker side, you can understand how that could be a very unsettling thing to, you know, it's like, is this company going to exist anymore? And do I still have a job? So it's a good idea often to, in the scenario where you're just selling your business and maybe you haven't considered selling to your workers, which is the more typical scenario, to wait a little bit of time. But through our diligence, toward the end of the process is when the working world tends to bring workers in. But I'll let you share your experience on that, Brendan, because I know it's very nuanced and in some ways delicate.
I mean, the simple rule is just as soon as possible, according to the owner. Usually owners just don't want you doing that in case they don't know if there's a deal yet. Some owners say, no, I want to have you talk right away. Great, we'll do it. And so as soon as it's comfortable for the owner, we want to start talking with the workers.
So is the employee expected to contribute to the purchase price?
Yes, there is a buy-in. It's relatively nominal, usually to the price of the business. It can be somewhere between $500 and $2,000. Sometimes it's waived, but we do like to have some skin in the game from employees.
And then Jesse has a really good question. What happens if the business owner wants to stay involved? How do they do that? How do they stay involved? Can they be a co-owner? How does that happen if someone wants to keep their toe dipped in?
Yeah, that's a possibility, and it has happened in the past. I don't know if with one of the examples that we looked at today, guys, Michelle or Alice, but it's absolutely doable that and I think encouraging in some way that the owner remains as a employee owner in the organization. It would be part of the deal that's struck and that's discussed during the whole process.
Now we just have a few more minutes for questions. It looks like we can probably do one or two more. I'm going to ask one, which is another one that I got when I was doing outreach with the businesses about the building that the business is in, right? So how is a transition managed if the principal selling the business owns the building, or B, the principal selling the business is a signator to a lease? How are those things managed through the transition process?
Guys, do you want to take this on, Michelle?
Yeah, Brendan, I think you wanted to perhaps add something to the previous question. Maybe you can answer this one as well.
We'll go for you. Want to answer this one?
Sure, yeah, that's not uncommon, especially in New York City. The building owner or the business owner / building owner could just lease the space to the worker-owned co-op, or we could move the co-op to another space, like we explained in the BKS in the Brooklyn Stone and Tile example. Yeah.
And let's see. Franco has asked, do the profits of the employees, oops, now I can't get, I'm losing it. Do the profits for employees go into retirement accounts? Is there a vesting period for new employees? How do subsequent employees that are brought on figure into the ownership pattern?
I can take this one. The question about retirement, that's closer to the ESOP model. So often that's what the trust is for. It's actually the profits of the company go into a trust, which is the retirement funds for the employees. With the worker-owned co-op, it's not really set up as anything to do with retirement funds, but there is something called a probation period, or there's different ways to say it, like a provisional worker ownership period, so that if there was somebody who was going to join the company as a worker owner, there would be a provisional period that may be 6 months, maybe a year or more, where they work for the company for a while with the intention of becoming a worker owner, and then they can be kind of approved by the other worker owners to become a full worker owner. So that would be kind of like the vesting period, but it wouldn't have to do with retirement funds.
What happens when an employee leaves the company?
So there's also the thing I forgot in that last part of my answer was that there's the buy-in amount that Brendan mentioned, which can be small or larger depending on how the business wants to set itself up. But that is basically your skin in the game. You have an internal capital account in the company. And when you put that money in, it goes into that internal capital account. And then as you can get distributions from the profits over time that go into your internal capital account. And then if you were to leave the company, you would be entitled to the value of your internal capital account when you leave, and the company can pay you out all at once or over time.
Great. And then we are really closing in on 11 a.m. here. And nobody else has one more question, I'm going to ask this one to our friends at the Working World. How do you approach businesses? Like how how do the businesses find you? How do you find them?
Well, for a long time, we've been working mostly through brokers, and we find businesses that are on the market already. So this is an exciting new path for us to be able to reach business owners like you today directly. Usually we are already talking to people who know they want to sell, and it's kind of like, sometimes it's like they want to sell yesterday. So it's not always, we don't usually have like the leisure of having conversations with the workers early and things like that. So this is kind of a new approach in a lot of ways to being able to talk to business owners and do outreach through partners like the SBIDC. So we are excited for that because there might be more success in being able to start the conversation earlier.
That's great. So, folks, what do you think? It is time. It is 11 a.m. I want to thank you guys for participating. Obviously, I want to thank Deputy Mayor Thompson's office, City Foundation, you guys for attending, Working World for sharing their expertise. Michaela, what would you like to add?
Yeah, thank you, everyone. Really grateful for this. Yeah, this is a success for us. And I will follow up with everyone who registered for this event with the presentation that we just gave. So, and also that you can have my contact in case you're interested in, having a conversation with us about whether you would be eligible or you would be interested in exploring this exciting alternative. So yeah, thank you, Leah, for moderating so kindly. Thank you, the Working World, also for providing so much expertise and insight. And that will be all. Have a nice day, everyone.
Thanks, you guys. This is
Thank
great.
you.
Have a great afternoon.
Thank you. Bye-bye.
Bye.
Thank you.